Hello everyone, welcome back to another video. If you're new to this channel, my name is Farhan and I help accounting students like you ace their exams. What we have got here today is a practice question which requires you to prepare the non-current asset account and also the accumulated depreciation account. We will calculate the profit or loss on the sale or disposal of the non-current asset. This question has some complications, so I need you to focus and follow through for an excellent understanding. So, with that being said, let's begin. Ashton supplied the following information for the year ended 30 September 2015. So, these are the balances that we are given at 30 September 2015 for the motor vehicles at cost, which is $240,000, and the accumulated depreciation of motor vehicles, which are $45,600. We know the depreciation method is the reducing balance method, and the depreciation rate is 20%. During the year ended 30 September 2016, the following transactions took place. On 31 August 2016, Ashton sold a van to Cars and Such on credit for $8,000. She had purchased the van on 1 October 2013 at a cost of $25,000. So we understand that during this financial year, we had some disposal for a non-current asset that happened, which we need to account for in our calculations. On 1 September 2016, Ashton purchased a new van for the business using her personal funds. The cost of the van is $19,000, and she was also charged $1,500 for import tax and $200 for the first tank of the diesel. We also bought a new non-current asset. So in this financial year ending 30 September 2016, we first sold one non-current asset and later we also purchased a new non-current asset. Ashton's depreciation policy is to charge a full year's depreciation in the year of purchase and no depreciation in the year of sale. The requirement in first part is to prepare the motor vehicles account for the year ended 30 September 2016, followed by the preparation of the accumulated depreciation account for the year ended 30 September 2016. You are to also calculate the profit or loss on the sale of non-current asset for the year ended 30 September 2016. So I need your attention to the workings we have got on the right hand side, and I'll walk you through what happens step by step. All right, so based on what happened in the question so far, we understand that we are working with a business where the most recent financial year started on 1 October 2015 and ends on 30 September 2016. Okay? So we are mainly interested in all the events and transactions that happened in between this period starting 1 October 2015 and 30 September 2016. The requirement of the first part of the question is to prepare the motor vehicles account. And here I have got the ledger account for the motor vehicles, which is represented by the usual 5-column format. As you can see, the 5 columns are date, details, debit, credit, and the net balance. Now, I need your attention in the question. So to begin the question with, we are given the balance at 30 September 2015 for motor vehicles at cost and the accumulated depreciation. All these closing balances, which we are given at 30 September 2015, will be carried forward as the opening balance on 1 October 2015. Okay? Now, at 30 September 2015, we were given the closing balance for motor vehicles at cost, which was $240,000. So this amount of $240,000 is the opening balance on 1 October 2015, the beginning of the new financial year or the most recent financial year that we're working with in our question. So in the ledger account, I'm starting with the opening balance at 1 October 2015, which is the beginning of the most recent financial year in this question. And the opening balance is represented by balance BD, which is also known as balance brought down. And the amount is recorded on the debit side, which is $240,000. which gives us a net balance of $240,000 debit. Now, why is the opening balance on the debit side? Because the motor vehicles account in itself is an asset account. All assets by default should have an opening balance on the debit side. This also means when assets increase, we debit them. When assets decrease, we credit them. Because we started the financial year on 1 October 2015 with the opening balance, it is to be recorded on the debit side as per the requirements. Okay? Now, in between this financial year, starting 1 October 2015 and ending 30 September 2016, we've got some events that occurred. For instance, on 31st of August 2016, we sold a van to Cars and Such on credit for $8,000, and that van was originally purchased for $25,000 on 1 October 2013. Okay? Now, I need your attention here where you will see I've written something in red. So I need you to understand the journal entry for the sale of a non-current asset. How is the asset account affected when there is a sale of the non-current asset? So we understand based on the requirements in the question that the van which we had sold on 31st of August 2016 had an original cost of $25,000. Okay? All right. So when we are selling this van, which originally costed us $25,000, we are actually getting rid of an asset. So when assets go down, we have to credit it. So that is why we are crediting the motor vehicles asset account by $25,000 to reflect the fact that we had just got rid of some asset which had an original cost of $25,000. And why are we getting rid of this? Because we have sold it. That's why the opposing entry, which is the debit entry, is the sale of non-current asset account, which is $25,000. Okay? Now, why did we need to understand this journal entry? Now, as you understand, the motor vehicles account is credited by $25,000, right? Which means when you prepare the motor vehicles ledger account, this needs to be credited. The $25,000 is recorded on the credit side on 31st of August 2016. Why? Because we have sold it. As you can see in the details column, we have included the sale of non-current asset account as the cross-reference. Now, at the end of 1 October 2016, we had a final balance of $240,000 debit. Now we have some credits coming in, which means we have to subtract $25,000 from $240,000, which leaves us with $215,000 debit. Okay, because obviously we have got more debits than credits. Okay. Now, on the 1st of September 2016, Ashton also bought a new van for the business. And this van was purchased using personal funds. You can think of this as extra or additional capital contribution. Okay. So if I go to the car company and I use my personal bank account to buy the car, which I know I eventually will be using in my business, this is some form of capital contribution into my business. Okay. Now, the cost of the van is $19,000, and there was $1,500 for import tax plus an additional $200 for the first tank of diesel. Now, the total cost of this van is the purchase price of $19,000 plus the $1,500 in import tax, which is $20,500. Now, why are we adding the import tax and the purchase price? This is because if you want to find the total cost of an asset, it is by requirement that all the costs necessary to get the asset ready for its intended use. Now, import tax adds value to this asset What is an import tax? An import tax is something that you will have to pay the government in your country because you're bringing this car from a foreign country, as a result of which you need to pay some duty or tax to your government. This adds the total cost of the car, which gets capitalized into the total cost of the car. Therefore, 19,000 plus 1,500, which is 20,500. But what about the $200 for the first tank of diesel? Diesel costs are seen as maintenance costs because the car cannot really run without you maintaining it or without you putting some petrol into it, right? So this $200 is seen as a revenue expenditure, which is relevant to the day-to-day operational costs of the business. But the import tax of 1,500 and the purchase price of 19,000 together combined to be 20,500 are both classified as capital expenditure because they refer to the increased value that's being added to this asset. Okay, so because we have purchased a new asset with a total cost of 20,500, our motor vehicles are going up, and when assets go up, we debit them. So that's why 20,500 is recorded on the debit side on the 1st of September 2016. What's the relevant cross-reference in the details column? Capital. Because as you understand, we have used our personal funds. This is some form of capital contribution. Although we have used our personal funds, we know that we are going to be using this in the business eventually. And how can we explicitly verify this? You will see the question says, Ashton purchased a new van for the business using her personal funds. So for the business, but using her personal funds. Personal funds is capital for the business, okay? Now, this 20,500 new debits will be added to the previous amount of $215,000 debit, which gives us $235,500 debit altogether, because both of them are debits, so we have to add them. Now, in the year 2016, we have got no other stuff that happened. That's why this final balance of $235,500 gets carried forward as the opening balance in the next financial year starting 1 October 2016, with the relevant details being the balance BD or balance brought down. Okay? All right. So if this was to come in your exam, this would be a 3 to 4 mark question. Okay? All right. Now, I'll give you 5 seconds to take down some notes and also get yourself ready for the next part where we will prepare the accumulated depreciation account. Okay? All right. So let's start with the next part. Now, the requirement of the second part of the question is to prepare the accumulated depreciation ledger account for the year ended 30 September 2016, which means we are mainly interested in what happened in between 1 October 2015, which would have been the beginning of the financial year, and 30 September 2016, which is the end of the financial year. Now, to answer this, we need to actually utilize all the information that we're given in the question with regards to the disposal of the non-current asset, the day it was purchased, and whatever happened since the day it was purchased. What do I mean by that? So let's have a look. So to begin our calculations or workings, I have created a section here for sale of asset. And why? You will see now. We understand that this asset was purchased on 1st of October 2013. And we purchased it for a total cost of $25,000. Okay? We understand that we're working with a business, but the financial year typically starts on 1 October and ends on 30 September of the following year. Okay? Which are the 12 months that we are concerned about. So year 1 would be from 1 October 2013, the day it was purchased, until the end of 30 September 2014, which are the 12 months we're concerned about. We understand, based on the company or business policy, that we are to apply a full depreciation in the year of sale, which is explicitly mentioned in the very last paragraph of the question. Full depreciation in the year of purchase can be calculated by multiplying the given percentage with the original cost. The given percentage is 20, which is given in the first paragraph. Here you will see the rate of depreciation is 20%, which I'm just highlighting in red. You can see, okay? So that's being multiplied with a cost of 25,000, which gives us $5,000 as the full depreciation. Now, I always recommend you to calculate the net book value every time you are using the reducing balance method because it makes our calculations easier moving forward. So the net book value at the end of the first year or at 30 September 2014, or the net book value at any given point in time, is calculated as the difference between the original cost and the accumulated depreciation. The accumulated depreciation is also known as the total depreciation we have got so far since this asset was purchased. But because we're in the first year of usage, the only depreciation we have is the depreciation we derived for year one, right? So the cost is 25,000, which we know. The total depreciation so far is 5,000, which we calculated in the previous line, okay? And that gives us a net book value of 20,000 at the end of year one, okay? Now, year two for this asset would start on 1 October 2014 and end on 30 September 2015. And because we're using the reducing balance method, the depreciation in year two is calculated by multiplying the given percentage with the net book value. The given percentage, as we know, based on the table given in the first part of the question, is 20%. And the net book value that we calculated at the end of year one was 20,000, which gives us a depreciation for year two of 4,000, okay? Now again, we want to find the net book value at the end of year two, which is at 30 September 2015. We understand that the net book value at any given point in time is the difference between the cost and the accumulated depreciation. But since we already know the net book value at the end of year one, that net book value has already accounted for the adjustment for depreciation necessary for year one. So it's logical to say that in year two, if you want to find the net book value, you could just simply take the net book value that you had got at the end of year one, which is 20,000, and subtract the new depreciation that you have calculated for year two. So 20,000 minus 4,000 would give you $16,000 in net book value at 30 September 2015. Okay? Now, we have one more year. So year three would start from 1 October 2015, which is the most recent financial year that we're working with in this question. And for this particular asset, the one which we have sold, this third year would have ended on 31st of August 2016. Why? Because the question clearly mentions that on 31st of August 2016, Ashton sold a van to Cars and Such on credit for 8,000. So this asset which we are working with, the asset which we have sold, was sold on 31st of August 2016. And based on the requirements given in the question, no depreciation is charged in the year of sale, which you can verify based on the very last line in the question. All right. How much did we sell this asset for? Which is $8,000. This is also known as the disposal proceeds in a fancier way. So this asset was sold for $8,000 to Cars and Such. Okay? All right. Now, before we sold this asset, we had a net book value of $16,000. Okay? Net book value represents the economic benefit still available for consumption for the purpose of generating revenue for the business. As you can understand, we had $16,000 worth of value remaining in our asset for consumption, but we ended up selling it for $8,000, which clearly means we ended up selling it for less than what it had remaining in terms of economic output. This clearly means we have sold it for a loss. So the loss on sale, so the loss on sale is therefore the difference between the net book value and the disposal proceeds, which is the amount we got by selling this asset, and that is $8,000. Okay, so the loss on sale is $8,000. So we've already calculated part C of the question. All right. Now, I also need you to know some few things. So the cost of this asset which we had sold, the original cost was $25,000, which we paid to buy this asset on the 1st of October 2013. The net book value is $16,000, which you just worked with. If that is the case, can we confidently say that the accumulated depreciation for this asset is $9,000 when we sold it, right? Because the cost was 25 and the net book value was 16, which means obviously the 9,000 that we are looking for has to be the depreciation which we have consumed, right? Which we have incurred due to consumption of that asset's benefits, right? So $9,000 is the accumulated depreciation, okay? Now, why do we need to know this? You will see when we prepare the accumulated depreciation account. But for now, I need you to note down that the $9,000 is the accumulated depreciation for this asset which we had sold, okay? Just hold onto it. We'll come back to it again. Now, you know that we have got some remaining old assets as well from 30 September 2014. From 30 September 2014, if you recall, the question had $240,000 of motor vehicles, which is quite a lot. We only ended up selling 25,000 of it in this financial year. So which means 240 minus 25, 215,000 is still left to be worked with, right? So what's the catch here? So what do we do? So let's see. So first of all, if I want to determine the remaining old assets that we can work with, I first need you to calculate the net book value at 30 September 2015, which is the net book value at the end of the previous financial year. How do we calculate it? At any given point in time is the difference between the cost and the accumulated depreciation. The cost is clearly given as 240,000, right? And the accumulated depreciation is 45,600. So we can just subtract 240,000 and 45,600, which gives us a net book value at 30 September 2015 of 194,400. Okay? This net book value of 194,400 at 30 September 2015 would have been the net book value for all assets that we had at that point in time, right? Now, we want to remove the net book value of the asset which we had sold on 31st of August 2016 from this total net book value for all the assets that we had got at the end of the previous year. So 194,400 minus 16,000. 194,400 is the total net book value for all assets that we had at the end of previous year, minus $16,000 in net book value for the asset which we had sold in the current financial year. That leaves us with net book value of 178,400, which is the net book value for the remaining old assets. Okay? Now, we are depreciating our 20% per annum using the reducing balance method. So now we will depreciate this remaining net book value for all old assets by multiplying 20% with the net book value, because obviously we're using the reducing balance method. So 20% multiplied by 178,400 would give us 35,680. All right. So let that sink in for a moment. Okay. I'll just do a quick recap of what really happened here. So at 30 September 2015, we were given cost of 240,000 and accumulated depreciation of 45,600. Using these two numbers, we can find the net book value, which is the net book value for all old assets, right? So 240,000 minus 45,600 gives us 194,400, right? In this financial year, ending 30 September 2016, we know we have sold one of the assets. That asset which we want to sell, had a net book value of 16,000. Okay, so 194,000 minus 16,000 would give us $178,400 in the net book value left for remaining old assets. Okay, now what we can do, we can depreciate this remaining old assets by multiplying the given rate of 20 with the remaining net book value of 178,400, and that would give us 35,680 as the depreciation for these remaining old assets. Okay? All right, just give me a moment. I want to plug my charger because it seems like my laptop is going to run out. One sec. All right, so now we are back again. All right, so we have taken care of the remaining old assets. Now what's left? We also know that on 1 September 2016, we purchased a new asset. And based on the company's policy, new assets are to go through a full depreciation in the year of purchase. So here I've got a subheading for purchase of new asset. So full depreciation is calculated by multiplying 20% with the total cost of 20,500. How do we get 20,500 again? It's $19,000, which is the purchase price of the van, plus an additional $1,500 in import tax. Okay? These two add to the value of the asset. We are not including the diesel costs because it's some form of maintenance costs. It's like a revenue expenditure. So the full depreciation is calculated here by multiplying 20% with 20,500, which gives us 4,100 as the depreciation for this new asset. So on that basis, what's the total depreciation expense in the year starting 1 October 2015 and ending 30 September 2016 that we will be transferring to our accumulated depreciation ledger account? It's 4,100, which is the depreciation we derived for the new asset, plus an additional 35,680, which is the depreciation for the remaining old assets. Okay? You can see that I am not including the asset which we had sold because, as you understand, the requirement was to apply no depreciation for the asset which we had sold in the year of sale. So altogether, the total depreciation expense for the year ending 30 September 2016 is $39,780. Okay? Now, the journal entry, every time you want to record the depreciation expense, which is basically at the end of the year. So the journal entry at 30 September 2016, every time you want to record depreciation, is to debit the depreciation expense, okay, by 39,780, which is the value in this case, and to always credit the accumulated depreciation account by 39,780. As you can see, I've written accum dep in short. All right, but you should write the full thing during the exam. Now, what's the logic here? So every time we have incurred some form of depreciation expense, our expenses go up in value. And when expenses go up in value, we always have to debit it. So that is why we have to debit depreciation expense, specifically depreciation of motor vehicles, because that's the exact asset which we are talking about. So debit depreciation expense by 39,780. We are crediting accumulated depreciation because accumulated depreciation is a contra asset account, which by default should always have a credit balance, which also means that when it increases, we have a credit balance. Now, what do we understand by accumulated depreciation when we say it's a contra asset account? A contra asset account records the reduction for a relevant non-current asset account. The relevant non-current asset in this case is motor vehicles. So all the reduction that are associated with these motor vehicles, which are non-current assets, as we use these motor vehicles, they lose their value, right? That value which they're losing is what we store in this accumulated depreciation account, which is what we call a contra asset account. And by definition, a contra asset account is an account which records the reduction for a relevant non-current asset account, and contra asset account by default should always be credited, which means when it increases, we will credit it. So accumulated depreciation, when it increases, we will credit it. Expenses, when it increases, we debit it. That's why we debit depreciation expense, and that's why we credit accumulated depreciation, both by 39,780. Okay? Now, why do we need to know this? We'll understand now. So we have the ledger account for accumulated depreciation here, which is the usual 5-column format. date, details, debit, credit, and the final balance. So to begin the year with, on 1 October 2015, you see the question wants us to prepare this account for the year ended 30 September 2016, which means from 1 October 2015 until end of 30 September 2016, whatever events have occurred need to be shown here. So to begin the year with, on 1 October 2015, we have an opening balance brought down, which is 45,600, which we can take from the information given in the very beginning of the question, which you can see I'm just circling on the left. So 45,600, and that is to be recorded where? On the credit side, because accumulated depreciation by default is always credited, as we have just discussed a while ago. Okay, so that leaves us with the final balance of 45,600 credit. Now, on the 31st of August 2016, we have sold one non-current asset, right? Now, take a look at the journal entry that we have on the left, the second pair I'm talking about, which is this one, okay? This one. And if you recall, I asked you to remember this $9,000 in accumulated depreciation amount, right? Right, $9,000 for the asset which we had sold. Okay. Why? When you are selling this asset is no longer remaining in the books. So the accumulated depreciation account needs to reflect the fact that it is no longer remaining in the books. We understand when accumulated depreciation increases, we credit it. Now that this asset no longer remains in the books, we have to reduce the accumulated depreciation account, which means we have to debit it to reflect the fact that we don't have this asset anymore. So that's why we are debiting accumulated depreciation by $9,000. And the opposing credit entry is the sale of non-current asset account by $9,000. Okay? Now, why do we need to know this journal entry? As you can see, the accumulated depreciation account is being debited in this journal entry, right? Which means in the ledger account for accumulated depreciation, we will record the $9,000 on the debit side to reflect the fact that we have got rid of this asset or we have sold this asset, with the relevant cross-reference in the details column being the sale of non-current asset account. Okay. Now $9,000 debit here is subtracted from 45,600 credit, which leaves us with 36,600 credit as the final balance. Okay. I believe that is clear. Now, what else happened? So on 1 September, we have purchased the asset, which is not important here because we need the total depreciation amount at the end of the year on 30 September. So on 30 September 2016, the total depreciation expense which we have derived is 4,100 for the new asset plus an additional 35,680 for the remaining group of assets, and that was 39,780. The journal entry says every time we have to record depreciation expense, we debit the depreciation expense account and we credit the accumulated depreciation account at the end of the year. So if we are crediting the accumulated depreciation account, then what's happening? In the accumulated depreciation ledger account, we will record 39,780 on the credit side. What can we write in the details column? We will write depreciation expense, but we have to be specific because we have got motor vehicles. It can be any non-current asset. So we will write depreciation of motor vehicles. Okay. Now, what's the final balance? So we have got 39,780, which is recorded on the credit side. That is added to the previous balance of 36,600. So let's do that. So I'll just use my calculator. This gives us a final balance of 76,380 credit at 30 September 2016, which is at the end of the financial year. But although the requirement in the question is to prepare the ledger account for the year ended 30 September 2016, always remember to show the opening balance in the next financial year. Okay, and the opening balance on 1 October 2017, which is the beginning of the next financial year, will be 76,380 credit. And why it's credit? Because by default, accumulated depreciation is a contra asset account, and all contra asset accounts by default are credited, which means they have an opening balance on the credit side, and when they increase, we also record them on the credit side. Okay, all right. Yep, that's a long lecture. As you can see, my throat hurts from speaking for a long time. But I believe you found value in this content. Okay, so I'll just wait for some time for you to make notes. Now, if you need help with other topics, make sure to post them down in the comments and I'll prepare some videos on those. Also, like this video and subscribe to this channel and share this channel and videos with your friends who you think will greatly benefit from these lessons. If you need coaching, I have got many slots open at the moment. You can check the link in the description to book a free Zoom call with me. My sessions are all online. You must bring your parents and we can structure something to help you prepare for your exams at the end of the year and get you that A1. All right. So that's all for today's lesson. I'll see you in the next one.